Let's get straight to it. The harsh reality is that young Americans are facing a financial storm that previous generations barely had to navigate. The combination of student loans, stagnant wages, and a hyper-competitive housing market has created a situation where financial freedom is not just delayed, it's almost out of reach for many. Think about it, tens of thousands of dollars in student debt hang over the heads of recent graduates, while wages barely cover the basics. This isn't just a small inconvenience, it's a structural problem that is reshaping the American dream. For decades, young people could rely on getting a decent job, buying a house, and gradually building wealth. Today, that path has narrowed, forcing many into cycles of debt and financial instability. It's not laziness nor lack of ambition. It's an economic environment stacked against them. Now, let's talk housing, because this is where the pressure really hits. Prices have skyrocketed in virtually every major city, making the dream of homeownership seem like a fantasy for first-time buyers. Renting long-term has become the norm, not the exception. Investment. And when you're paying 40–50% of your income just to secure a roof over your head, saving for the future feels almost impossible. The housing market isn't just inconvenient, it's actively shaping a generation that might never accumulate assets the way previous generations did. It's a domino effect without equity. Young people can't invest, can't leverage wealth, and remain financially vulnerable throughout their lives. Then there's inflation. It's not a distant number in a government report. It's real money leaving your pocket every single day. Food, transportation, healthcare, utilities. The cost of living is rising faster than wages. Young professionals aren't just living paycheck to paycheck. They're losing ground in every measurable way. And the irony, while the cost of living soars, policy decisions often favor older generations or wealthy investors, leaving younger people to bear the brunt of economic mismanagement. The very system that promises upward mobility is tilted, making wealth accumulation for millennials and Gen Z harder than ever. Finally, let's zoom out and look at the bigger picture: systemic inequality. The economy has been structured in a way that funnels wealth to those who already have it. Tax breaks, investment incentives, and policy decisions frequently benefit older Americans who already own homes, businesses, or stocks. Meanwhile, young people are left with minimal tools to build wealth. Investment. This isn't speculation, it's the observable reality. The generational wealth gap is widening, and unless significant changes are made, young Americans will continue to face an uphill battle, struggling not just to survive, but to thrive in an economy that seems increasingly indifferent to their success. The financial landscape for young Americans has become increasingly challenging, and nowhere is this more apparent than in the burden of student debt paired with stagnant wages. Graduates today are entering the workforce carrying debts that often exceed tens of thousands of dollars, a weight that previous generations rarely faced. The promise of higher education as a gateway to upward mobility now comes with significant risk, and for many, it has become a trap. Tuition costs have risen dramatically over the past few decades, while wages for entry-level positions have barely kept pace with inflation. This means that even after completing their degrees, young people are left in a position where a large portion of their earnings must be allocated toward repaying loans rather than investing, saving, or building assets. The psychological impact of this burden is immense as well, creating stress, anxiety, and a sense of financial paralysis. Many graduates delay major life milestones such as buying a home, starting a family, or even pursuing entrepreneurial ventures because their income is primarily tied to servicing debt. Beyond student loans, stagnant wages compound the problem. Even as living costs rise, salaries for entry-level and mid-level positions have not experienced comparable growth. Investment. Jobs that previously offered a comfortable start to financial independence now barely cover basic expenses, leaving young workers trapped in a cycle of work and debt repayment. This disparity between education costs, wages, and living expenses contributes to a generational inequality. Investment, where young people are forced to navigate an economic system that inherently favors those who inherited wealth or entered the workforce decades earlier under different financial circumstances. The gap between aspirations and reality becomes even more pronounced when considering the need to save for emergencies, invest in retirement, or take risks necessary for long-term financial growth. A graduate burdened by debt has limited capacity to invest in the stock market, purchase property, or even participate in entrepreneurial opportunities that could offer significant financial returns. This is not a reflection of a lack of ambition or discipline. It is a structural challenge that limits opportunity despite education, skills, and determination. Moreover, as economic conditions fluctuate, young people remain vulnerable to changes in interest rates, job markets, and inflation, all of which can exacerbate financial stress and reduce their ability to achieve long-term stability. The consequences extend beyond individual financial health, impacting society at large. Lower rates of home ownership, reduced entrepreneurial activity, and limited consumer spending all stem from a generation constrained by debt and inadequate income. These dynamics create a ripple effect that influences broader economic growth, innovation, and social mobility. Addressing this issue requires a systemic understanding of how student debt and wage stagnation intersect to limit opportunity, alongside proactive strategies for education financing, career development, and economic policy that prioritize sustainable financial independence. Solutions might include expanding access to affordable education, restructuring loan repayment programs, investment, and fostering wage growth in entry-level positions to match rising living costs, providing young Americans with the tools and freedom to pursue financial goals without being trapped by debt. The housing market has become one of the most significant barriers preventing young Americans from achieving financial stability and independence. Over the past decade, home prices have risen at a pace far exceeding wage growth, particularly in urban areas where job opportunities are concentrated. For first-time buyers, this creates an almost insurmountable challenge. Saving for a down payment alone can take years, even for those earning above average incomes. The traditional path to wealth building through homeownership, a cornerstone of the American dream, is increasingly out of reach for millennials and Gen Z. Many young people find themselves locked into long-term renting, often paying a substantial portion of their monthly income on rent alone. This not only limits disposable income, but also prevents accumulation of equity, which has historically been one of the primary means of generating generational wealth. Renting provides shelter but does not contribute to financial growth, and as rent continues to rise, the ability to save for future investments, education, or retirement becomes severely constrained. The challenge is exacerbated by a highly competitive market. Limited inventory, combined with historically low mortgage rates in recent years, has intensified competition for available homes. Bidding wars have become commonplace, and the barrier to entry continues to climb. In addition, the criteria for mortgage approval remains stringent, requiring stable income, good credit, and often substantial savings, criteria that many young adults struggle to meet while managing student debt and other living expenses. Investment. The consequence is a growing generation of financially capable individuals who are nonetheless excluded from property ownership simply because the market has shifted so dramatically. This situation also has broader societal implications. Delayed home ownership affects family planning, community engagement, and economic mobility. Home ownership is not just about having a roof over one's head, it represents a foundation for stability. Investment, the ability to leverage assets for wealth building, and a measure of financial security. Without access to affordable housing, young Americans face a cascade of limitations. They are less likely to invest in the stock market, less able to start businesses, and more likely to experience prolonged financial stress. Moreover, this imbalance fuels inequality between generations. Older homeowners benefit from decades of property appreciation, investment, while younger generations are forced to navigate a rental market that extracts wealth without offering an avenue for accumulation. Even when attempting to enter the market, high interest rates or inflation-adjusted mortgage payments can make ownership precarious. The combination of rising housing costs, limited supply, and slow wage growth creates a structural barrier that prevents young people from achieving the financial milestones once taken for granted. Addressing this issue requires innovative policy solutions, including increasing the availability of affordable housing, offering first-time buyer incentives, and reconsidering zoning regulations that restrict supply. Additionally, financial education and planning tools can help young adults navigate these challenges strategically, though systemic barriers remain a significant obstacle. The urgency of the problem is clear. Without meaningful intervention, investment, an entire generation risks being locked out of homeownership, limiting wealth accumulation, financial independence, and long-term economic security. Inflation and the rising cost of living have become relentless pressures on young Americans, creating a financial environment where saving and investing feel nearly impossible. Everyday expenses, from groceries and transportation to healthcare and utilities, have grown at rates that consistently outpace wage increases, leaving many young workers struggling to keep up. Even those with stable jobs find themselves allocating the majority of their income to essential expenses, with little left over for discretionary spending or long-term financial planning. And this dynamic creates a vicious cycle. Without the ability to save, young adults cannot build emergency funds, invest in the stock market, or prepare for retirement, leaving them financially vulnerable to economic shocks. Unlike older generations, who often benefited from lower costs of living relative to income and opportunities to accumulate assets early in their careers, younger Americans are navigating an environment where every dollar feels stretched. Inflation affects not just the cost of goods, but also the real value of wages. While salaries may nominally increase, if they do not keep pace with the rising prices of necessities, the purchasing power of those wages effectively declines. Investment. This hidden erosion of income means that even seemingly modest lifestyle improvements become out of reach, forcing many to make difficult trade-offs between immediate needs and long-term goals. Compounding the problem is the interplay between inflation and debt. Young people carrying student loans, credit card balances, or other forms of debt face higher interest payments as rates adjust, further squeezing their budgets. What might have been manageable debt a decade ago now becomes a heavier burden in a high-cost environment, reducing the ability to invest or save. Moreover, the rising cost of living discourages risk-taking and entrepreneurial activity. Investment, starting a business, pursuing additional education, or relocating for better job prospects all require financial flexibility that is increasingly scarce. Without that flexibility, opportunities for wealth creation diminish, and economic mobility becomes constrained. The challenge also extends to housing and transportation costs, which are disproportionately high relative to income growth. Rent and home prices in major cities have surged, while car prices and insurance premiums continue to climb, meaning that even basic necessities consume a disproportionate share of young adults' earnings. As a result, lifestyle inflation, or the gradual increase in spending as income rises, is effectively forced upon this generation, leaving little room for strategic financial planning or accumulation of assets. Furthermore, social expectations add pressure. Young Americans are expected to maintain a certain standard of living, contribute to social obligations, and manage professional growth, all while facing economic realities that make these expectations difficult to meet. Without structural changes to wage growth, cost of living adjustments, or broader policy interventions, the financial strain on young people will only intensify, limiting their ability to achieve stability, security, and long-term financial independence. This economic squeeze is reshaping priorities, influencing decisions about family, housing, education, and retirement, and altering the trajectory of an entire generation. The economic system in the United States has long favored certain groups over others, and the effects of these systemic biases are increasingly evident when examining the challenges faced by younger generations. Policies and financial structures often benefit older Americans or those who have already accumulated wealth, while young people face significant barriers to building assets and achieving long-term financial stability. For example, tax incentives frequently favor homeowners and investors, allowing those with existing property or stock portfolios to grow wealth more efficiently, while first-time buyers or individuals without inherited assets struggle to enter these markets. This creates a situation where wealth is disproportionately concentrated among older generations, exacerbating the generational wealth gap. Access to capital is another critical factor. Young adults often find it difficult to secure loans or favorable interest rates without a substantial credit history or collateral. Meanwhile, established investors or older individuals have long-standing relationships with financial institutions and can leverage credit and investments to further increase their net worth. These systemic advantages contribute to a cycle in which wealth begets more wealth, leaving younger generations at a structural disadvantage. Additionally, the allocation of government spending and economic support often prioritizes sectors that do not directly address the financial needs of younger populations. Programs and policies designed to stabilize the economy may inadvertently favor established industries or high net worth individuals, rather than creating opportunities for young workers to build savings, purchase homes, or invest in education. The result is a widening disparity in wealth accumulation, where younger Americans must navigate higher costs, rising debt, and limited avenues for asset growth, while older generations continue to benefit from policies enacted decades earlier. Another aspect of systemic inequality is the labor market itself. Many entry-level positions offer wages that fail to keep pace with inflation or the cost of living, while benefits such as retirement contributions, stock options, investment, or employer-assisted housing are often reserved for more experienced workers. This means that young people face both immediate financial constraints and long-term disadvantages in terms of wealth building opportunities. Beyond employment, access to financial literacy and advisory resources is uneven. Individuals who grow up in households with financial knowledge or generational wealth have an inherent advantage in navigating investments, savings, and risk management, while others must learn through trial and error, often incurring losses that can delay financial progress. These systemic issues reinforce a broader pattern in which economic structures favor those who already have resources, making it increasingly difficult for young Americans to break into wealth accumulation or achieve the milestones of financial independence that prior generations took for granted. Without intentional interventions to address these imbalances, the generational wealth gap will continue to widen, limiting upward mobility and entrenching economic inequality. Strategies such as revising tax codes, expanding access to affordable housing, improving financial education, investment, and creating incentives for young investors could help level the playing field. But systemic change requires recognition of the structural barriers currently in place and a commitment to policies that provide equitable opportunities across age groups. ensuring that wealth creation is not confined to those already positioned advantageously within the system.